Hey, it's Brian from Ledger Status, and in this video, I'm going to make an attempt to explain options, the way you can use options both for speculation, for hedging, making funds available in other ways. Options are super interesting. It is like a full toolkit, whereas if you treat buying common shares being like using a hammer or something like that. And they're powerful, they're dangerous, but they really open up a lot of opportunities. They can be used smartly, or you can use them as some kind of enormous leverage tool. In this video, I'm going to use Bitcoin options as my example, since I have primarily a crypto audience. But these principles can apply across many different asset classes, basically anybody that offers options as a trading tool. All right, let's dig into it. This is the Deribit Position Builder, and I'm going to use it as my tool. It's super handy, pb.deribit.com. This allows us to visualize our trade and understand what we're looking at. So let's get started with the very basics of an option. First, we're going to choose our expiry, which is the date that this options contract expires. I'm going to choose March 27th, and our instrument, I'm going to start with what's called an at-the-money option, or close to the money, since these options are spread out a bit, every $500 or $1,000, depending on which expiry, which is also known as your strike date, and then your strike price is the instrument. This is a $10,000 call, so even though the price of Bitcoin is $10,400, this is close to at the money, meaning the contract that you pick is roughly the same price as the current price of the asset. So if we put one contract, that's going to be one Bitcoin worth of exposure of this instrument. In stock options, one contract is representative of 100 shares of the stock. So keep that in mind. Depending on what asset you're trading and where, that can change a bit. But in the case of Bitcoin, on Deribit, they're one contract per Bitcoin. The price of this is 0.1262 BTC, or $1,300. So you're paying $1,300 for the option to buy Bitcoin on March 27th for $10,000. So that means no matter what the actual price of Bitcoin on March 27th is, you will have that right to buy one Bitcoin for $10,000. If you take it all the way to March 27th, you don't exit this contract, then the contract will be worthless if it's below $10,000. The price of Bitcoin's below $10,000, because you can just buy Bitcoin for whatever lower price, $6,000, $7,000, $8,000, $9,000, and you don't have to worry about the contract itself. You just get it at the market rate. Where this comes into play is when Bitcoin is worth more than $10,000. So however much more than $10,000 it goes, you will have the right to buy Bitcoin for $10,000, and therefore there's this place in between. Since you paid $1,300 for the contract itself, really Bitcoin needs to be worth $11,400 or so in order to break even, because remember, you're buying a $10,000 Bitcoin, but you paid over $1,300 for the opportunity to make this decision in March 27th, even though today's February 12th. What's that mean is you actually make money on this decision if the price is beyond that break even point. So if Bitcoin is worth, say, $13,000, you would have made about 0.1 Bitcoin profit on locking in this contract. Now, a speculator is going to look at it basically only in the sense of, how can I lock in this contract? Other people are just going to say, well, I just want to secure my ability to buy this Bitcoin, or oftentimes in the case of puts, to sell this Bitcoin. In our case with a call, it's the right to buy that Bitcoin. Our red line is at the time of expiry. Our green line is whatever the time identified here between today and the time of expiry. So that green line changes. So this contract is going to change in value and get closer and closer to the red line as that day comes into fruition, because there's this time component that's really important to understand in options to be able to establish the time value of that contract, and it diminishes over time, and therefore you get that theta decay in the option itself. So that's what we're tracking there between the green line and the red line. So when you're simulating these, you might say, okay, well, what's my estimation if I go out 14 days, if I hold this contract for 2 weeks? Because most people are actually going to sell out of this option that they've purchased before the actual strike date. If you go all the way until the strike date, in this case for European options, it'll just execute the profit or loss. It won't actually buy that Bitcoin for you. American options, it'll actually execute the buy or sale of the asset underlying. But in this case, let's say I actually want to sell this sometime in the next 2 weeks. Well, while your break even, if you go to expiry, is that 11.4 price, your break even in 2 weeks is only around 10.7. So if you buy a $10,000 call and we're above 10.7 in 2 weeks, you're going to be in profit on this option. So as a speculator, if you think there's volatility coming, let's say if you think we're going to move $2,000 over the next couple of weeks, or 20%, then your profit would align somewhere along this green line and be actually a little more, because there's still some time value in that option in addition to the inherent value of the option. So that's how you would look at a basic call. The price of these contracts change relative to how far away the contract price is relative to the current price, and also the amount of time between now and whenever this contract expires. So let's use another example, and let's say September 2020, and we'll use the same $10,000 call, and we'll go long, and let's remove our March one. Well, now look at this one. You're actually paying, what do we pay? We paid 0.26 Bitcoin. So whatever that was, $2,700 for that privilege. So we're paying more because we're securing our ability to pay $10,000 for one Bitcoin for a much larger period of time. So our break even on this one, Bitcoin has to be worth more like 13.5, 13.6 K at the time of expiry. In the 2 weeks out from now, we will have less of this opportunity for decay because of time, because you're going to have less decay of the option the more time there is out into the future. So if you don't know exactly when a move is going to be, you may choose to go a little bit farther dated to give yourself a little more time. You may also do some other things like choose an in-the-money option, which we'll cover. But just it's important to keep in mind this differential in terms of the price of the option, depending on what your strike price is and your strike date, because you can see how much more expensive this September call is relative to the March call, because, well, it builds in another 6 months or whatever that is of time for you to be able to execute this option. And the person who sold you the option is carrying the risk of it going against them, because if it goes up, they're losing money because they gave you the right to buy that Bitcoin from them way back here. What they did, what the incentive of a seller is, think of like a miner who may do this, or a business with a lot of Bitcoins on their balance sheet who wants to secure a price for them. They may choose to sell calls for their Bitcoins because they want to ensure that they can sell these Bitcoin for $10,000. And they collect a premium on top of that, and then they are required to sell them for 10 grand. If the price of Bitcoin goes down, they're nicely protected. If the price of Bitcoin goes up, then they still guarantee the 10K, and they collect the 0.26 BTC per BTC they sold at that price. So it's kind of a win-win, although if it goes way up, 15, 16, 17, 18K, they're going to be pretty salty, but it allows them to have a little more stability in their balance sheet. That's what true hedging for selling a call would be for somebody that has a lot of Bitcoin exposure. And then the speculator or the person that wants to have that 10K Bitcoin for one reason or the other as a predefined amount, they're happy too. Now, most people are purely speculating on this stuff, so they're never going to hold it all the way to expiry, and they're going to look for the optimal time along this timeline and price relationship for when they should sell this option. So the day you buy it and the strike you buy it, the price you buy it, that's the central axis. That's when everything's good. Everything below is at a loss, up to 100% loss of your premium. So if you paid 0.26 BTC for the opportunity to buy Bitcoin and it doesn't ever hit 10K, then you're going to lose that whole premium, and then you can go buy your Bitcoin for whatever price you wanted to back here. A speculator, typically you buy a call, you want the price of the call to go up so that some number of days. Let's go back to our example. Let's say 2 months. Let's say you wait 2 months. So 60 days out, you want to be able to sell your option when Bitcoin's $13,500 and collect 0.09, 0.1 BTC of profit. So that's what you would look at when you're buying a call like this. Now, this is just a call, example of 2 calls. The other is to be able to buy a put. So let's stay on September and we'll buy a $7,000 put. Now we're going long a put, meaning we're wanting the price to go down. And again, this can be another way to hedge for someone that has a justification for this versus selling a call. Selling a call and longing a put are a similar concept, but there's more opportunity, I guess you could say, in longing the put. And when you're selling a call, that's more of a strategic thing. So when you're longing a put, then in this case, it's everything we just described, except for it's in the reverse direction. You're still paying. You're paying 0.04 BTC. I could have shown a $10,000 put, and it probably would have been similar in price to the $10,000 call. Probably maybe a little more expensive, actually. Let's take a look. Yeah, 0.145 Bitcoin, so it's cheaper. So sometimes that alone can tell you about the nature of the market. Your $10,000 put is a good bit cheaper than your $10,000 call. So that that shows you that there's more demand for those $10,000 calls than the $10,000 puts. Nevertheless, there's the same equation of how much you stand to make depending on the age of the contract, etc. So what are some other things you could do? Well, someone could, for instance, they could buy multiple positions. They could stack these. So you could have bought that $10,000 call for March, but you could say, you know what, I want a $14,000 call for September that costs 0.15. So now you've spent roughly, 0.29 BTC. 0.29 BTC, but you have 2 Bitcoin worth of exposure at 10 and 14K. And your downside is that full 0.29 BTC. That's what you stand to lose. Your upside is pretty similar to if you were holding 2 Bitcoin worth of actual physical Bitcoins. It'd be that plus the price of the contract. This that delta there. That would be your additional inherent value in the contract. When someone may do this, they could maybe they hold 2 Bitcoin and they say, I'm going to go sell these 2 Bitcoin to cash, and I'm going to go buy 2 Bitcoin worth of calls in case there's additional upside, and I'm going to pay 0.29 BTC to do it. Now, if they don't want to choose these, they can choose a mix and match of strike dates and strike prices to be able to suit their needs for what they want to do. All right, that's an example again of using a multi-leg strategy, but really that's two of the same types of legs. So maybe this March 10K call is pretty safe, but you're a little afraid about this 14K one because it's further out of the money. What if Bitcoin doesn't go up fast enough? Then you still end up losing the contract value and it doesn't work out for you. So you may play one a little safer, one a little more degenerate, if you will. And then there's another concept where you might create something called a spread. So in this case, I'm going to get rid of both of these. Let's say you think Bitcoin is going to go up between now and March, and let's buy a $12,000 call. We're going to long it. That one costs us 0.05 BTC. That's fine, but we don't necessarily know that Bitcoin is going to move right this moment. So in addition to buying this $12,000 call, we're going to also choose something nearer dated, let's say 9 days out from now, and Bitcoin's 10.4 right now. Let's see what the price of an $11,000 call is. Now this time it's 0.017. So we're paying 0.05 to go long 1 Bitcoin in March. We're going to get credited 0.0177 Bitcoin because this time we're actually going to short. So this time we're using a spread, is what this is called. So this is a vertical spread so that we want the price of Bitcoin to go up, but we don't want it to go over 11K. Because if it goes over 11K, just like before when we were in profit on our long call, now we would be the person who was selling it, not the person who's buying it. So what we're doing here is we're helping pay that price of the theta, the time decay, by selling a similar call, but nearer dated and at a little bit lower price in this case, so that we catch a little bit more of this contract premium. So what you do in this scenario, and you may do it once or twice or 3 times over the course of the lifetime that you hold this March 27th 12K call, is you might sell nearer dated calls to help pay for your longer position. The only time, and it's not an unreasonable risk, it's very possible, when you might get upside down would be if it goes over 11K, then you start to lose profit on that. And if it gets over $11,500, so a really rip-roaring type of move over the course of those 10 days, then you actually start to be in the red, even though on your baseline thesis, you were long, you wanted to be long that March 12K call. If that starts to happen, and if you think it's going to continue, there's a variety of ways to try to work your way out of that. You can try to get rid of this and sell out of it, or you can actually also do something like buy futures to try to stay more neutral. There's different things that you can do, different strategies. But for the most part, what you want, notice that your profit goes up the farther along the contract period we go. And that's because the longer it takes to get to 11K, you're going to earn more and more profit here. So you're collecting that premium at 11K, and theoretically, we're going up fast enough to where you're not losing too much, or maybe you're gaining on your 12K call. So in an ideal world, you're collecting on that 11K call you sold, and you're in profit on the 12K call that you bought. If you get lucky enough to do this 2 or 3 times, you can even pay for the entirety of that March 12K call, that 0.05 BTC, by correspondingly selling these nearer dated calls for whatever they average up to. Generally, you're going to need a lot of protection in your account, especially if you don't have a net zero position here. So the 1 and the 1. If I was to say, oh, this is genius, let me just go ahead and sell 3 Bitcoin this way, and I'm going to collect basically the full value of that contract. Well, you might be able to do that. However, you do run risks, one of which is the slope. If this option goes against us, the slope of our losses escalates severely, because now we are on the hook for selling our Bitcoin for only $11,000. But if Bitcoin is now 11.5, we're losing $500 per Bitcoin, which is a lot of risk, and we may not want to take that. And for the exchange to even allow us to do that, we have to have enough in our account to be able to justify that. So you generally want to think of these in the sense of, if you're going to hedge your long call positions, you want to do kind of a one-to-one basis. The other thing you might do is, if we had our 12K call, and let's say we had our September 14K call, well, now we have 2 Bitcoin that we're long, and maybe we'll go 2 Bitcoin short. And so we have a similar situation here. And in this situation, in the case of downside or sideways, we're not losing quite as much. And in the case of going up, we're doing even more to kind of pay for these positions. So that's how you might look at that, as a multi-leg strategy in one direction. There are many more strategies that you can look at. For instance, you could be just a net seller of premium in general, and you may hedge that against your spot positions. So you can combine, that was 1 Bitcoin. So let's say you were long $10,000, and you still like your position, but you you don't want to exit your long perp position, but you do want to hedge it by selling those 11K calls. Well, now you're still going to be profitable when Bitcoin goes up. You don't start losing money again until after 11K, but you're going to start reducing your profit potential as it goes up. But you're still here, your overall delta or your bullishness or bearishness, you're not like super bearish or anything. So you only, you have this opportunity to collect premium while you're still long. This might be one method if, for instance, premiums are really expensive on longs. You may try to pay for those by selling options against it. So that's another way of blending two entirely different types of products. And notice, if we do one-to-one in this scenario, I had 2 calls that we were selling there, and that made it much riskier. Notice how it goes all the way down here, start losing money. If you just do 1 call that you're selling, you basically start flatlining and not losing any more money, but not gaining either. And that makes sense, right? Because you're making money from your long, improving profit, but you're losing money by that call that you sold going against you, and now you're losing additional funds because you're not keeping the Bitcoin value beyond 11K. So the ideal situation here is you may hedge your long position with one of these near-dated calls that you sell. That's a little bit more complex of a situation, but it's another opportunity that you have. You can play with the simulator to see, like, how does this all come together. Now, these types of strategies, you really need to practice. There's names for all this stuff, iron condors and butterflies and strangles and spreads and straddles. For the most part, people are going to look at Bitcoin options as a speculative thing to enhance their ability to go long or short. However, there may be scenarios where there's more than that you can take advantage of. I hope this helps. I like to use options in several scenarios, and I showed you that complicated one purely to show that there's these really complicated types of strategies that you can do. Personally, I tend to use these directionally, and then maybe I'll hedge, like via that vertical spread type of scenario. And then another might be, if I just think there's volatility coming, then that tends to be when options are cheaper. So in that scenario, I might choose to go both long and short on Bitcoin, and I make money purely from having volatility. So you can see in this scenario, I did 1 put and 1 call. That may seem silly, like, how are you going to make money? Well, the way you make money in that scenario is that essentially it moves enough to push you into the profit no matter what, because it's paying not only for the cost of its own option, but it's also paying for the other option. And you can structure these in a whole bunch of different ways. For example, you may not choose to do the call portion, but you do, keep your long on that you had. So in this scenario, you've still got that put. So now if Bitcoin goes down, you paid 0.0239 BTC. So you paid under 2.5%. So that if Bitcoin goes down a lot between now and February 28th, your risk is really limited, where you still maintain quite a bit of upside, just whatever your upside is minus that 0.024. So that's how you can use these kind of in combination to accomplish your goals. I hope this helps. This was more in depth than I intended at first, but this is also the 4th time I've done this video, and I wanted to make sure I got everything in there. You can go to pb.deribit.com to explore and build out your own options. Depending on where you live, different people have different places where they might be able to trade options. Right now, Deribit has options. CME has options for Americans, and there's other places as well. And this will change over time. So just look wherever you can trade options in your jurisdiction, and then keep this in mind for how you can use options to your advantage to increase your trading tool belt and the stuff that you have at your disposal to adjust your positioning in the crypto ecosystem. Go to ledgerstatus.com if you enjoyed this, and check out our podcast. I'd love that very much, and share this with your friends, all that good stuff. Okay, thanks so much. Catch you later.